Welcome to this explainer. You know, when most of us hear the word bank, our minds immediately jump to massive Wall Street trading floors, right? Frantic stock markets, complex derivatives, the whole shebang. But today, we're actually stripping all of that away. We're going to look at the absolute foundational engine of our global economy. Using official sustainability accounting standards, we're going to decode exactly what a traditional commercial bank does, the social and environmental risks it navigates day in, day out, and how it's actually held accountable to the public.
To do that, we've got a pretty clear roadmap. We'll start by explaining commercial banks. Then we'll dive into the pure play difference, categorize the FNCB sector, look at social impact and inclusion, examine environmental and systemic risks, and finally, wrap up with ethics and accountability. Let's just jump right in.
Section 1. Explaining commercial banks. So to really grasp the specific sustainability metrics we're looking at today, we first have to define the fundamental role these institutions play in our daily lives. According to the industry standard, commercial banks do something that's incredibly straightforward, yet absolutely vital. Basically, they accept deposits, and they make loans to individuals and corporations. They also fund real estate and massive infrastructure projects. So the crucial takeaway here is that their primary economic function is acting as a facilitator. It's almost like a giant financial matchmaking service. They take capital from where it's just sitting idle and transfer it to where it can be most productive. The whole industry literally runs on deposit volume, loan quality, and prevailing interest rates.
Section 2. The pure play difference. Now, we really need to clear up a common misconception here and draw a hard line around what we're actually analyzing today.
When you look at massive, integrated financial institutions trying to report on sustainability, things get muddy really fast. So, the standard explicitly defines what makes a bank a pure play commercial bank. Looking at the core functions, you've got accepting deposits, making standard individual and corporate loans, and infrastructure lending. But then there's the stuff that is explicitly excluded from this specific standard. We're talking investment banking, brokerage services, mortgage and consumer finance, asset management, and insurance. Why exclude them? Well, because the sustainability risks of complex Wall Street trading or underwriting insurance are just totally different from traditional lending. To get a clear, accurate picture, we have to focus strictly on traditional, pure play banking services.
Section 3. Categorizing the FNCB sector. Let's move on and see how this pure play activity is officially categorized for accounting, and how we measure its sheer scale.
Under the Sustainable Industry Classification System, or SICS for short, pure play commercial banks fall right under the financial sector, with the specific code FNCB. These classifications are governed by the SASB standards, which are now actually under the umbrella of the IFRS Foundation. Think of the IFRS as the global referee for financial reporting. Having them in charge ensures we have a globally recognized, totally standardized way to look at how these banks operate, no matter what country they're based in.
Now, to understand the sheer scale of a bank's impact, the standard doesn't just look at gross revenue. Instead, it uses very specific activity metrics. They look at the actual number and the total value of checking and savings accounts for personal and small business customers. They also meticulously track the number and value of loans across personal, small business, and corporate segments. And, keeping with our strict, pure play rule, these loan metrics explicitly leave out mortgage loans and revolving credit. That strips away the noise and gives us a really pure look at the bank's traditional footprint.
Section 4. Social impact and inclusion. All right, now that we've nailed down what a pure play bank is and how it's measured, let's look at the real-world social consequences of its daily operations.
What's absolutely fascinating about these standards is just how heavily they weigh data security. As banks get more and more tech-dependent, safeguarding your personal financial data is paramount. The standard actually requires banks to disclose the total number of data breaches, what percentage of those involved personal data, and literally how many unique account holders were affected. Failing to stop sophisticated cyber threats? That's not just an IT headache for the back office. It directly damages consumer confidence and takes a huge bite out of the bank's bottom line.
But beyond just protecting data, banks play a massive social role in capacity building. It's about making sure communities aren't completely left behind by the modern financial system. Banks have to constantly balance the risk of lending with the opportunity to serve previously underserved markets. The standard tracks this using financial inclusion metrics. Banks have to disclose the number and amount of loans that explicitly promote small business and community development. They also track the number of no-cost retail checking accounts they provide to unbanked or underbanked customers. And we mean truly accessible accounts, without those hidden monthly maintenance fees or punishing minimum balance requirements.
And simply providing access to an account isn't quite enough to guarantee real sustainable value for a community. Banks are also measured on metric FNC B-240A.4. This looks at the total number of individuals who actively participate in the bank's financial literacy initiatives. These are educational programs targeted right at unbanked, underbanked, or underserved customers to help them make safe, informed financial decisions.
Section 5. Environmental and Systemic Risks. Moving beyond individual retail accounts and local communities, we have to look at the macro level. How do these massive institutions handle big-picture threats?
Because commercial banks act as financial intermediaries, they end up contributing to some pretty significant positive and negative environmental and social impacts, simply through who they choose to lend to. So banks must publicly disclose exactly how they incorporate ESG, environmental, social, and governance factors, into their credit analysis. They have to explain how things like climate change, natural resource constraints, or human capital risks actually influence how they assess a corporate borrower's creditworthiness. It even impacts how they estimate potential credit losses, how they value posted collateral, and figure out the maturity of a loan.
And this brings us to one of the absolutely most critical environmental metrics in modern banking. Banks have to disclose their financed emissions. This means they literally have to measure the greenhouse gas emissions tied to the activities and the specific companies they fund. By measuring Scope 1, 2, and 3 financed emissions, which basically covers everything from the direct emissions of a factory they funded to the indirect electricity that factory uses, right down to the emissions from the products it sells, we get a really comprehensive look at the bank's exposure to climate-related financial risks.
Of course, environmental risks aren't the only massive macro threats out there. The global financial system is so incredibly interconnected that a failure at one major commercial bank can trigger a complete financial meltdown. To measure this systemic risk, banks have to disclose their Global Systemically Important Bank, or GSIB score. This assesses their sheer size, complexity, and how interconnected they are. They also have to detail how they use both mandatory and voluntary stress tests to prove they have enough capital reserves to survive a severe economic shock without needing another massive public bailout.
Section 6. Ethics and Accountability. Finally, let's explore how these institutions are actually held legally and ethically accountable to the public and to their shareholders.
Strict regulatory compliance is simply non-negotiable in this industry. The standard requires commercial banks to publicly track and disclose the total monetary losses they incur from legal proceedings. And we're not talking about a little slap on the wrist here. We are talking about tracking real, multi-million-dollar fines and settlements linked to fraud, insider trading, antitrust behavior, and market manipulation. Alongside that, they have to detail just how robust their internal whistleblower policies are, proving that their internal controls actually work and that employees are truly empowered to report violations.
Knowing all of this, how a pure-play commercial bank operates, and exactly how its sustainability is measured across data security, financial inclusion, environmental risks, and business ethics, it really begs a final, personal question. We all interact with these institutions, but based on these strict metrics, do you actually know what your bank is doing with your money? Does your bank's pure-play impact align with your pure values? Thanks for joining me on this explainer. Keep learning, and I'll catch you in the next one.